All right, so in this video, I'm gonna give you a step-by-step guide on how to get started with dividend investing as a brand new investor. And by the end, you should have everything you need to get rocking and rolling. Now, when it comes to dividend investing, one of the first questions that we really need to answer is what the heck even is a dividend? And it's pretty straightforward. So when you buy shares of a stock on the stock market, that makes you a shareholder or technically a part owner of that company. And companies often make profits from their business operations, at least that's the goal. Well, a dividend is a share of those profits that the company gives to its shareholders. So when a company decides to pay a dividend, it means that they're distributing a portion of their earnings to the people who own their shares. It's kind of like your share of the company's success. Now, with that said, why should you care? What are the benefits to owning stocks that pay a dividend as opposed that do not? Because not every company does. The first reason you may want to consider dividend investing is because it allows you to build long-term wealth and create a steady passive income stream without having to sell any shares of your stocks down the road. You see, when you invest in stocks that do not pay a dividend, someday when you're ready to retire and you want to start living off of your investments, you'll have to start selling off the stocks that you just spent the last couple or the last few decades accumulating in order to fund your lifestyle. And there's not necessarily anything wrong with that, by the way. That sort of strategy has worked just fine for many people for a long time. But personally speaking, I like the idea of not having to sell off the assets that you just worked so hard to acquire, and the income from dividends gives you that option. And because many companies actually have a tendency to grow their dividends over time, if you don't sell those assets and hold on to them, there's a pretty good chance that your income will increase as the years go on, which obviously is exactly what you want. Now, the second reason you may want to consider dividend investing is because, as studies have shown, dividend-paying stocks on average have outperformed their non-dividend counterparts over the long run. Now, that's not to say that it will be like that forever and always, and that's definitely not to say that there are no exceptions to this, but this recent study by Hartford Funds found that companies that consistently pay and grow their dividends have historically outperformed both their non-dividend paying counterparts and the S&P 500 as a whole. As we can see here, if you would have invested $100 in 1973, you would have ended up with a considerably higher amount today by investing in the dividend growers and the dividend payers than if you would have invested in the S&P 500. Anyway, the third reason you may want to consider dividend investing is because of the psychological benefits it offers. Because dividend investing by nature is a buy and hold strategy, it can significantly reduce the stress that comes along with constantly having to check the market, and it can prevent you from making frequent trades in and out of stocks. When you invest for dividends, you are more so focused on the long-term health and stability of the companies in your portfolio rather than the short-term market fluctuations that will happen along the way. This can help you avoid making rash decisions whenever these market downturns do happen, and during these times, the regular dividend payments can provide you with some sense of security and even excitement as you see those dividends continuing to come in while other investors may be panicking. So with all of that said, what do you need to do to officially get started with dividend investing? Well, step one is you need to choose a brokerage. This is where your portfolio will be held, and this is also the platform you'll use to buy and sell stocks. Now, there are a lot of great brokerages out there, and I encourage you to explore them all to see what might be the best fit for you, but I personally use Charles Schwab for my main account, and then I use M1 Finance for my Roth IRA retirement account. And there are some other great brokerages out there worth looking into, like Vanguard, Fidelity, and Robinhood, at least here in the United States. And truth be told, which one you should invest with in a lot of ways just comes down to personal preference. It's not like there's a right or a wrong brokerage. It's really whatever you find to be the best fit. And with that, now that we've established the why and the where, it's time to get to the what. What should you invest in? And from here, you have a couple of different directions you can go. You can either invest in individual companies one by one, or you can invest in what are called exchange traded funds, or ETFs for short, which essentially are big baskets of different stocks that you can buy all bundled together instead of having to buy each individual stock separately. One example of this is an ETF called SCHD, the Schwab US Dividend Equity ETF, which is one of the most popular dividend ETFs out there, and it contains over 100 different stocks, many of which are going to be household names that you probably recognize, like Verizon, Home Depot, Coca-Cola, and Pepsi. SCHD is a big part of my portfolio. I invest into it every single week, and in general, I think ETFs are the best place to start for most brand new investors. It keeps things simple. It allows you to immediately build a well-diversified portfolio, and you don't have to worry about doing any stock research. Overall, I think it's just a great way to get some skin in the game, and I wish I would have started out with ETFs. When I was first first getting started with investing, I went all in on individual stocks, which in hindsight, I don't think was the right move. But like I said, I started investing with no prior experience, pretty much from scratch, so I didn't know any better. And everything I've learned so far, I've had to learn on my own the hard way as I've gone along. With that said, considering how deep I've gotten into this stuff now, pursuing it for my formal education when I was going to college back in the day would have been a really good thing for me, and it really would have helped me avoid so many of the mistakes that I've made along the way, especially as a brand new investor. And with that in mind, I want to talk to you about today's video sponsor, Southern New Hampshire University. As someone who actually didn't finish college and most certainly wasn't after a degree in finance when I was going, there are times where I don't feel the most qualified to talk about some of the topics we cover here on this channel. Because of that, I'd be lying if I said that I've never thought about going back and finishing my degree. And if you feel the same, if you feel like your experience is holding you back from pursuing the career that you really want, then I am so excited to tell you about today's sponsor, Southern New Hampshire University. SNHU has one of the largest accredited nonprofit online degree offerings in the country, and I want to talk to you specifically about their finance program. In this program, you'll learn to identify long-term corporate investment opportunities to increase shareholder value, apply theories of asset allocation, security analysis, and portfolio diversification to efficiently manage an investment portfolio, utilize the rules and regulations for financial accounting and reporting in a global economy, generate financial records and financial statements for users in accordance with governing rules and regulations, and analyze, interpret, and communicate financial and accounting information to internal and external stakeholders. SNHU is radically affordable, with their tuition rates being some of the lowest in the nation. Also, when you go to request information about one of their 200 plus different programs, a real person will hop on the call and discuss how the program can benefit you personally. To learn more, go to snhu.edu/Ryne or find the link in the description to find out what the current average annual salary is for someone with a finance degree and to request more free information about the program. It only takes one click to find your calling, so once again, go to snhu.edu/Ryne. Now anyway, getting back to it and moving on from ETFs, let's say that you still wanted to buy some individual stocks. Would that be the end of the world? Not necessarily, but it does beg the question, what should you be looking for? Speaking from experience, if you're going to buy individual companies, especially as a brand new investor, I think the best place to start is by looking into companies that you're already familiar with. And for me, these were companies like Starbucks and Procter & Gamble and Coca-Cola, but there are a lot of other great dividend payers out there you'd recognize like Walmart, McDonald's, Nike, and Bank of America, just to name a few. So there's quite a few options. From here, as you start to identify some potential companies that you're familiar with that you might want to invest in, you're going to want to do whatever research you can into these companies. And this is where it gets tricky as a brand new investor. And this is why I think ETFs really are the way to go, because when you're just starting out, you really don't know what to look for, and you really don't know how to discern between a good investment and a bad investment. But when it comes to learning how to do stock research and starting to look at some of this stuff, I think the easiest place to start and the best place to start is by becoming familiar with some of the dividend stats. And there's a few key terms you're going to want to know, the first of which is the dividend yield. This number represents the amount of income you can expect to receive in relation to the company's current share price. And to find the dividend yield, you would take the annual dividend paid per share divided by the company's share price. So for example, if stock XYZ paid $3 in dividends per share and it was currently priced at $100 per share, it would have a 3% dividend yield. The next metric you'll want to learn is the payout ratio. Like we mentioned earlier, a dividend is a share of the company's profits that you get for being a shareholder. And the payout ratio reflects the percentage of those profits the company is distributing to its shareholders. And you can calculate this number by taking the annual dividend paid per share divided by the company's earnings per share. So for example, stock XYZ once again pays $3 per share in dividends, and in this example, they have an earnings per share of $6. So the payout ratio would be 50%, which is not too shabby. A low payout ratio indicates that the dividend isn't taking a huge chunk of the company's earnings, which is both good for the company and is also good for investors because it indicates that there's still a lot of wiggle room for the company to sustain the dividend in case they go through a period where times are tough and earnings aren't as high. And it also gives the company more of a runway to grow the dividend, which brings us to the next metric, which is the dividend growth rate. This measures the annualized rate at which a company's dividends have grown over a specific period, and usually we look at it over the last 5 years. Now, dividend growth is definitely something that you want because it literally means that you are getting a pay raise for doing pretty much nothing besides being a shareholder. And we see a lot of companies with lower payout ratios able to grow their dividends at more aggressive rates. We can look at Lowe's, for example, which has a very low 31% payout ratio. And as you can see, they've grown their dividend by nearly 20% on average over the last 5 years. That's insane. Another example is Snap-on, who has a 35% payout ratio, which is also very low. And they've grown their dividend by about 14.5% on average over the last 5 years, which is still great. Now, to reiterate, it's going to be easier for the company to grow their dividend if that dividend is a smaller percentage of their earnings, which makes the inverse of this also true. If the payout ratio gets too high, then the dividend growth likely won't be as much, but also there's a chance that the dividend could no longer be sustainable, which we'll talk more about in just a moment. First, we need to talk about this last metric, which is the dividend growth history. This is a pretty easy one to wrap your head around. All it does is tell you the number of years the company has consistently grown their dividend. And actually, there are a select group of companies that have grown their dividends for so long that they are considered dividend royalty. We've got dividend aristocrats like Chevron, Aflac, and Clorox who've increased their dividend every year for at least 25 straight years, and dividend kings like Coca-Cola, Procter & Gamble, and Target who've been able to consistently grow their dividend for at least 50 years. Now, while dividends are never guaranteed, and even the kings can cut their dividends at any given time, an extensive growth history still matters because it shows that these companies have been able to weather various economic storms and have still managed to reward their shareholders during the tough times. So wrapping all of that up, just in terms of the dividend stats, you want to look for a company that has a history of increasing their payments, and you want to make sure that that dividend is sustainable with a payout ratio that's not too out of whack. And what you don't want to do, guys, this is important, what you don't want to do is just go looking for the stock with the highest yield possible. That is a recipe for disaster. Let's look at a company called Orchid Island Capital, ORC, as an example. Their dividend yield is insanely high at just over 18%, which might have you seeing dollar signs, and many investors get drawn in by that high yield, but there's more to the story. The company has a minus 200% payout ratio, which means they actually have negative earnings, and their 5-year dividend growth rate is minus 20%, which means they've actually been reducing the dividend over time, and that's obviously the opposite of what you want to see. And there's a name for this particular type of stock. We call them yield traps, and essentially a yield trap is a stock whose dividend yield is mouth-wateringly high, but is actually too good to be true, and Orchid Island Capital fits that description to a T. With its super high yield and declining dividend payments, you want to avoid these yield traps at all costs. Okay, now moving on. We've covered a lot of good ground so far, but one of the last things that you might still be wondering is how much should you invest? Like, what's a good amount? And there's really no right or wrong answer here. At the end of the day, it's really just about however much you feel comfortable with. And as a brand new investor, someone who's just starting out, there's nothing wrong with starting small, even if it's just $5 a week you're contributing or $10 a week, whatever it is. You can always increase it from there. And when I first started investing, that's exactly how I did it. I started small with maybe $5 a week, $10 a week, and then over time, over these last few years, I've slowly worked on increasing those contributions. And now I'm at a point where I'm investing over $200 into my portfolio every single week. And my hope is to continue to increase this amount over time. But for you guys just starting out, start small. You can always increase it from there. And now from here, let's say that you followed all of these steps so far. You've got your brokerage account all set up and you're investing, X dollars per week. You've got some ETFs. Maybe you've got a couple stocks, none of which are yield traps, by the way. Great job. But what happens next? Now that your portfolio is all set up, what happens from here? Well, you are off to the races, my friend. From here, as you continue to invest, you'll see your portfolio grow over time, and soon you should see some dividend payments coming in. Most stocks and ETFs pay dividends on a quarterly basis, so there's a good chance you won't be getting a dividend payment coming in immediately right off the bat. It might take a couple weeks, it might take a couple months, just depending on when you start buying. But when you do finally get that first dividend payment, it will likely be automatically reinvested back into your portfolio, which is totally fine. That's what you want, especially when you're just starting out. By continuing this process of investing, collecting dividends, and then reinvesting those dividends back into your portfolio to go and buy more shares, and repeating this over a period of time, you're creating what is known as the dividend snowball effect, which is extremely powerful. It is one of the best things in the world, and that's what I'm telling you about in this next video right over here. With each reinvestment back into your portfolio, your dividend snowball just grows bigger and bigger and bigger over time, and it will reach a point where the growth of your portfolio truly becomes an unstoppable force. Click right over here to learn more about that. It's really cool. I'll see you in the next one.